All right. We're on. We're live. I always have to give props to our marketing guy for the intro. It's always, I don't know if we deserve that kind of intro, but it's always nice. So we've got people live on Facebook, LinkedIn, and YouTube, and then I think maybe some people are logged straight into our into the media outlet that we have here. But today it's a follow-up to the April 8th webinar that I did that was hosted by MJBiz back last month. And there was a lot of unanswered questions. So I thought we would do this webinar as a follow-up to give people the opportunity to ask more questions about the approaches and just to get some more clarity on what it was that I was talking about. So I'm really encouraging everybody who is watching right now to consider putting in the chats your questions. I can bring them up on the screen so that everybody can see the question, and then we're going to answer. And then with me today, I have Jamie Jorgenstone, who's kind of the brains behind Calyx CPA. She's like the tax code extraordinaire.
Uh-oh.
And I thought that I would bring her on too to back me up this time. So if anybody gets me with a heavy question, she could chime in. And then, of course, I'm Justin Bautier, CEO of Calyx CPA, and you guys have probably seen me speak a few times out there. Hey, maybe we just go into a question that was kind of left over from the webinar on April. This is, essentially it's just kind of the question that we're answering in this. Even though the HHS believes cannabis should be Schedule 3, it's still Schedule 1 according to the DEA and therefore the IRS, right? And yes, that's true. And that is the IRS's, apparently the IRS's interpretation of the tax code, and according to 280E. Now that's where 470. We're not going to talk a lot about 471. If you guys have questions, please ask about that. But this is about whether or not 280E applies, in my opinion. That's what we're talking about. And if you look at the tax code itself, it says that 280 applies to businesses that are trafficking in a substance that meets or fits the meaning of a Schedule 1 or Schedule 2 drug. And that's kind of where the big argument is what did Congress mean by the meaning of? Why didn't Congress say that 280 applies to businesses that are trafficking in a controlled substance, Schedule 1 or Schedule 2 drug? Why didn't they just leave it at that?
Yeah, they didn't say like as defined or by the current scheduling, under the, they said within the meaning.
If a drug is a Schedule 1 or Schedule 2 drug, they said if it fits the meaning of, which gives us a huge opening here. And this is kind of the one that we're exploiting. So for some reason, the IRS apparently is not going to make any effort to determine whether on its own whether or not cannabis fits the meaning of, and instead is waiting for the DEA to reschedule it. But ultimately, when the HHS wrote the letter to the DEA saying, and the HHS is a scientific body, and the FDA is a scientific body. And they clearly in that letter and in the supporting documents that they provided clearly indicate that cannabis falls in a Schedule 3 classification if you're looking at the definition of a substance and doesn't belong in a 1 or 2. And so once that happened, because the HHS is a federal authority and the FDA is a federal authority, that's when we decided that 280E doesn't apply anymore at that point. We still use a 471C methodology to protect our clients. If the IRS wants to dispute our no 280E approach, we can fall back on 471C. But ultimately, if you look at the tax code and you read that HHS document, from my perspective, it's a close, it's done.
So, and I'll hop in a little because Justin likes to say it like a little bit, you know, stronger than maybe I like to say it. But I think, you know, personally, we believe that, you know, that is a really solid interpretation, but also professionally, like as, you know, CPAs, as accountants who are going to be preparing a tax return, I think the most important thing is that we believe there are these legal arguments here that allows a taxpayer to take a position on the tax return that's considered to have, you know, what's called a reasonable basis. And if a tax return or if a taxpayer takes a position with a reasonable basis, that's built into the, you know, to the tax code and to the Internal Revenue Manual that taxpayers can challenge, you know, the interpretations of the tax law, and they can disclose positions that are contrary to, you know, what the IRS has interpreted. And it's because the IRS is not the final say; they don't have the final say in it. You know, the courts do, Congress does, the courts do, right? So there are these mechanisms built in to the tax code and into our whole system that allow a taxpayer to take a position contrary. And that's what we do. We file this. There's specific forms to file those disclosures, whether they be general disclosures or a very specific form to disclose a position that is contrary to IRS regulation. So, you know, what's important is you're not just completely disregarding the law, and that you're not doing something that there's no real basis for it. There's no legal argument that what you're doing is allowable, right? But here we have, you know, we have cases going through the courts, trying to work their way up to the Supreme Court, arguing that 280E shouldn't be applicable for a number of reasons, right? Constitutionality. And then we have these other, you know, legal opinions that are arguing that, you know, cannabis doesn't fall within the meaning. That's another really solid argument that's rooted in a lot of evidence. It's like an evidence-based argument. So if you file a tax return that meets with a position that has a reasonable basis, you avoid, the IRS might ultimately disagree with you. You could even lose in the tax courts if you chose to continue to challenge it, but you are generally protected from like punitive penalties, you know, that say you did this wrong, you disregarded the law, and like you're not going to be, I won't say not, it's unlikely you will be penalized for it. You know, they can ultimately disagree, and you can have that position challenged. There's levels, right? So the IRS can just audit you, or they can deny your claim, and you can say, okay, like that's okay, I don't want to fight it anymore. And you still have a good position to avoid penalties on that. You can challenge it the next level. You could take it to appeals, and then, you know, appeals can ultimately settle with you, or they can say, you know, we still don't agree with your position. And then you can still leave it there, or you can say, okay, no, like I still want to fight for this, and you can take it to tax court, and then the tax courts can decide. And even if the tax courts decide your position, you know, we don't agree with you ultimately, you know, you're protected. And so you kind of are left right back where you would have been otherwise if you know, chose to take a more conservative route and to not, you know, and to not attempt to take this position. So it's kind of interesting, but to answer that question, yes, the IRS does consider cannabis a Schedule I drug, and it does consider 280E to be applicable at the surface level. That doesn't mean that every return that takes a position not applying 280E will get audited or will have their, you know, their return denied, because the IRS can choose not to pursue it. They can choose like not to. Or it could be that you know, they do dispute the position, and then the taxpayer has a choice of how they want to continue to, you know, challenge or not challenge.
Yeah. Well, that's why I brought up 471C, because and I do bring it up, not only because it's an effective way to mitigate 280E that has a little bit more history than what we're doing here, but because it kind of just shows what the IRS's typical approach is. And granted, they will audit people and they will try to make a spectacle out of people, but they do have to be, they have to be judicious with their resources as well. And so, it's my opinion, I don't know this, I've never talked to anybody from the IRS about their specific methodology for who they audit and who they don't audit. But I feel like based on our history, having been doing cannabis tax returns for close to, or 10 years now, and our 471C approach with our disclosures, we did have one get audited in which it was a 471C, but it was only because there was a prior tax return to that was done under a 471A approach, in which we were trying to negotiate, I guess, a cost of goods sold amount. But the 471C approach hasn't really been disputed in tax court and nationally. And that is according to our tax attorney colleague that we like to visit with frequently, that you probably heard from him, Nick Richards. But he, in a webinar that we did together not too long ago, he said that it doesn't look like there are, according to his network of accountants, the IRS has not taken a 471C to tax court. They're not making adjustments if the taxpayer has good books and records and use that approach. So again, and now it's even a stronger argument, now with the overturning of the Chevron deference, where the IRS doesn't quite have as much power.
And what's interesting or important, I think, to point out is that they did, on the surface, the IRS did, not as explicitly as they've done with this 280E applicability issue, but they did discourage people from using it. They discouraged the industry. It was widely kind of, for years, the accounting industry more widely said, no, you can't use it. Most people were afraid to use it because the IRS did kind of discourage it. They sort of vaguely implied, right, with that wording that it wouldn't be allowable. And they didn't come out and say, hey, everybody, our position has changed and we believe this is inappropriate, methodology for the cannabis industry to use. They didn't. And, in a way, they have a pretty good reason to not do that, because if what they've done discourages people from taking huge amounts of deductions, and that just means tax revenue is much higher, right? So I think what Justin is trying to get at is they may not ever say that they agree with this position explicitly, and they have explicitly said that for now, when cannabis is scheduled the way it is, 280E applies. They may not choose to pursue that battle if taxpayers choose to challenge it. We don't know. We'll have to wait and see. But they might just sit and wait and hope that what they've said discourages, many people, most people in the industry from, kind of taking this position. So that's
that's kind of what they do. They like rattle their sabers. They do a lot of like trying to discourage or to deter, and it works. Because like everybody's like, we don't want to bump up against the IRS. Like their people are afraid, and accountants, and a lot of accountants don't have time to really devote to researching these approaches and implementing them effectively, because they aren't doing cannabis day in and day out. They're general listeners. They're more afraid to getting a tax return done on time than than taking the time to mitigate the 280E impact, which is a bad.
I think accountants they're just rule followers, and so there's nothing scarier than breaking the rules. Right. And so they are scared of the IRS. And I felt that way for a long time too, until I got some hands-on experience and realized they're generally not punitive. They're just doing their job. If you're really going in with a good faith argument and you're not combative necessarily, you're just like, hey, this is kind of our opinion here and how we see it. It's not such a scary experience, which is which is maybe news to a lot of accountants. I think that they're scared of it, and maybe it is. I think it's a really good point, Justin, that accountants are busy. They don't want to deal with audits, even if they're not scared of the IRS. They don't want to deal with corresponding with the IRS. They've got a lot to do. So yeah, it's
at what expense though? That's the
right.
thing. At what expense? So so a question that was left over from the 488 webinar that I did with MJBiz is two questions. Have any of your dispensary clients tried to avoid 280E tax burden on their 2024 federal return using this rationale? And how many of your clients have been audited? So do you want to take it?
Yeah, I'll say that I don't know the exact numbers, but the majority of our clients, I'd say more than 50% of our clients, used the position on their 2023 tax returns filed in the 2024 financial year. So far, we have not had any of those, originally filed returns taking that position disputed. We haven't seen any of those disputed. It's tough to say. It's still very early in audits, and those types of things tend to lag behind by a couple years. But none of those have been disputed. We have been using this position also in 2024 or on 2024 tax returns filed, in the 2025 financial year. And then we've had, a number of amendments we've done, which should we speak to those as well, Justin? You want to go ahead and speak to those?
Yeah, I mean, to restate what you said, we've been going for no 280E since 2024, in 2024.
For about a year now, probably.
For about a year, yep. And then we're continuing to do it with 2024 tax returns. But in addition, we have started to amend tax returns to originally we were doing 2020 tax returns before the statute of limitations ran out last year. And now we're amending 2021 returns before the statutes run out this year. Go for it, Jamie.
Yeah. So we've had a variety of results with our amendments, I'd say. So we started filing the amendments, I'd say, I think it was summer of 24. And any of those amendments, I think, that were filed in summer, in the summer, went through, and we saw refunds come through for at least most of them. Maybe some are still there. The IRS always has some trouble processing amended returns. It just takes time. So some maybe are still hanging out. But then near to Q3, Q4 of 2024, we filed amendments, and then we started to see kind of an array of results. So some continued to get refunds. Some have not been processed yet. And we got one denial letter. Well, two denial letters for two different reasons. One was, I don't want to get too technical, but it had to do with statute of limitations and the IRS's interpretation of the statute of limitations versus ours. So that one was not really related to the 280E position, but rather just they were saying the statute of limitations.
Well, they just got crossed in the mail.
No, it was, I'm thinking of the one where we were trying to reduce the tax liability, but no payments had been paid yet. So that one was denied.
Yeah. That wasn't related to 280E. That was just a different amendment. That was an amendment of a hemp company that we did.
Really?
Yeah, because it was their prior accountants treated them as subject to 280E, but they were a hemp company. So we moved
interesting.
280E altogether. We didn't include any of our language or anything. We're just like, this isn't.
You're just like, it's not even. Okay, well, I guess I was
280E. Yeah.
Okay, so there's that one. Yeah, the other one, the IRS. The other one, the IRS just didn't plug in the right date, basically, right? Because
they didn't put in the right date.
They're supposed to do the postmark date, but they did the received date, which got us outside of the statute.
They'll try to get away with it. They'll try to find any reason to deny it.
You gotta know your stuff so that you can say, no, you guys are wrong about that. So that really, again, wasn't related to 280E. And then we got one very interesting denial letter. And I think this one is interesting for a couple of reasons. And one is that it was one of our clients who has several separate companies filing separate tax returns, 3 of those companies filed amended returns and were all mailed out on the same date. 1 was processed and received the refund. The other one is still waiting to be processed, and the third got a denial letter. So just kind of funny that it's this, related entities, whatever.
It depends on who
picks it up somehow, who gets it. Yeah. So there's not necessarily a clear approach yet that we've seen the IRS taking, but they denied it in a very interesting way that, we consulted with, as Justin mentioned, our tax attorney friend, colleague, and we kind of both agree that they issued the wrong type of denial letter. So there's like one type of denial letter that says, basically like there was an administrative error on your return. Like maybe we don't have a proper signature, or there's some like administrative error that doesn't allow us to process this return. So we're just denying it. And then like that error should be fixed, and then you can like try again. But there's not like an appeals process that goes along with that. There's no sort of like dispute. There's like not really like a taxpayer right, because you just simply did not prepare the return. Like you didn't dot your I's and cross your T's, right? That's all it is.
They're saying we did it wrong.
You just did it wrong. And then there's another type of form, which is when a claim, like a refund claim or just an amended return, is denied based on a variety of reasons. But one of those reasons is, a mismatch in how the law was applied. So the IRS believes the law was just applied incorrectly, and so then they're going to reject that amended return. So we got this denial, and we should have gotten that second type of letter for that type of denial. And with that type of denial, you do have appeals rights, and the taxpayer is able to deny that. They're able to dispute that. They're able to challenge the IRS's, defend their position, basically. We got that first type of letter, and so it's kind of like they gave us the wrong letter. Hard to say whether it was intentional or not. We can speculate all day. But ultimately they gave us that letter and didn't give us any sort of, information on our rights of appeal. And now we're kind of in the process of addressing that, but that's very new. It's within the last month or two, kind of lined up right with the end of our tax season. That was very busy. So we're kind of trying to pursue that, but we've heard of a few of those types of denials going out. I don't know if that's potentially the IRS's. They mentioned in December of 24 that they were going to address this 280E issue, and they were going to have a task force to figure out how they're going to address these amended returns and that type of thing. Maybe this is what they've come up with, but there's a lot. There's kind of it appears to be in violation of the taxpayers' Bill of Rights, and basically they're not giving taxpayers the proper ability to be heard and to defend their positions. And it could be that there's some, I don't really know what to expect, but there could be just some sort of consequence to the IRS just for simply failing to give the right information to the taxpayer.
Yeah, I think that there's administrative procedures that they're required to go through. It's kind of like if somebody tries to if a police officer tries to arrest you and then they don't read you your rights, when you get in front of the court, they're like, well, you didn't read them their rights. So
yeah, does the case get thrown out? Does it get thrown out, or do they just get a walk free? So we'll see how that goes. We kind of have to wait and see, but we have only received, personally, our firm has only received one of those letters. And we've seen far more refunds than any sort of denial, but right. It might be taking a turn. And
they're sitting on them, they sit on them for a while. But I've recently heard from one of our clients who called proactively, and actually he went to the ERC. I don't know if you guys are familiar with the ERC, big wave of employer credits that people are getting. And he went and talked to them, and then he talked to them about their amended returns, and they sent them to another department, and the guy's like, okay, we'll get on this right away. We'll push this forward. So that's one way. I think we got to just call and tell them to encourage them to do something with it.
There is some sort of timeline, but I need to refamiliarize myself with what that timeline is. I think they need to do something within like 6 months, or else there's some kind of something that happens, but I don't recall exactly how that works.
So in short, to answer the question, how many of our clients have been audited? So far, none. Knock on wood. Knock on wood. And actually, so far, only 2 out of all of the cannabis clients that we have prepared taxes for in the last 10 years have been audited. So that's interesting, because that's like almost statistically 0. So I honestly attribute that our language that we're putting in there, it could be very intimidating if you're like the IRS agent that picks that sucker up and you start reading that legal jargon and you're like, I have other things to do. I don't want to deal with this one. But here's a good question that I get a lot, and I hear people talk or people say that they've done. In fact, I was just talking to somebody who had just got done paying their attorney their attorney $80,000 to write an opinion. And that's being pushed out there. Like, you got to talk to the tax attorneys, and the tax attorneys write between $25,000 plus to write an opinion. I'll let you know who the 25,000 people are if you want, if you really want to do it, so you don't have to pay $80,000, hopefully. But Jamie, what do you think about the opinion? Like, what do you think that it's important that taxpayers get an opinion from an attorney?
I think it depends on the type of business you are. I think if you're like a public company, and you have a lot of, you have shareholders, and you have a lot of, different types of obligations and requirements, then I think an opinion is probably necessary, right? I don't think you're probably not even really allowed to go forward without an opinion. Yeah. I think if you're a small business, that's completely impractical. You can't do it, especially when you're already paying, you've historically paid how much more in taxes, over the life cycle of your business. How is like a normal kind of small business supposed to do that? I don't really believe that that this position has to just be inaccessible to people who don't have $80,000 to spend on an opinion, or even $25,000. I think that you should be prepared, or you should be well educated, right? So I think you can take this position, you can take it, you can take this position in a way that protects you generally. With a lot smaller investment. It does still require more than like what you would pay a normal accountant, for example, right? Your normal everyday accountant. The position is risky for both the taxpayer and the tax preparer. And so there is, and it requires a lot of, specialized kind of expertise. So you do have to pay for that. But then you don't necessarily need to throw so much money at it, just proactively, right? So you can know you might have a better result if you had that opinion, but still be willing to work with like an auditor for a little while, and then decide if you need to bring like a tax attorney in to represent you. You can do money that way. You can use your money that way. You should always set aside reserves so that if your position is disputed and you don't have the resources to even defend it, that you may need to pay back that tax, and some interest on the tax you underpaid. But I don't really believe that opinion is necessary. I think what we do and the position that we take is very, it applies to everybody. A lot of the lawyers, recommend that you have a very specific write-up. It's specific to your operations and the details of your operations. But I think the arguments that we lean into here are really just about the industry as a whole and the applicability of 280E as a whole to these state legal businesses. So I don't know that, I think a kind of templated style argument is okay in this case, at least to get your foot in the door,
Yeah.
and then you give it a shot and you can decide whether you want to invest more into that as the situation evolves.
Yeah, I think, I mean, that's what is unique about an opinion, is it kind of goes, at least if my understanding is correct, it kind of goes through like, this is the business, so this is what you're doing, and this is a cannabis dispensary in this city, in this location, and it has this much revenue. And I might be wrong, but it seems like that's the kind of depth they go into, and then ultimately they're like, and they're subject to 280E, and now here's the reason why we don't think they should be subject to. Well, in our tax returns, we communicate with the IRS through the 8275, which is a form that we're required. And I think, Jamie, you touched on it earlier. It's a form that we're required when we're like, we put that in there when we are telling the IRS, hey, we don't necessarily agree with your position, or it's an ambiguous position, and now we're interpreting it this way. You might interpret it this way, but we're interpreting it this way. And so it kind of serves as the same thing. And we actually had an attorney write ours up, right? So it's not like it's totally not, it's all on us. But maybe if you're looking for bigger refunds, most of our clients are, I would say probably the biggest refund we were going for was maybe like less than 2 million for sure, but over 3 years.
Yeah. That's a good point.
For like $1 million, like per return, then maybe you go ahead and pony up that little extra money for the.
And it may even be the threshold where that you're going to be subject to the Joint Tax Committee review. So that maybe I'll touch on that real quick because I think that's important. Is refund claims for individuals of 2 million or higher for a single tax return, as far as I understand it, or 5 million or higher for a corporate return, they're required to go through like a second level of review. Like they have to, and it's this higher level. It's called the Joint Tax Committee, and it has to, they review this return specifically to decide whether that refund should be issued or not. If you're at that threshold, then I think you're a much better candidate for that opinion, because these, that Joint Tax Committee would look at that opinion and they would weigh it, right? You would send it in with your tax return. They would review that alongside your return and make their decision. I think for the ones that don't meet that threshold, I don't think it's very necessary. Now, even if you're going to be at that threshold, again, you just have to there's kind of a risk benefit analysis, and you have to decide how you want to. You don't have to necessarily pay the money on the front end to give this a shot. You can let it go through even Joint Tax Committee review and see what they say, and then maybe you can spend the money defending the position when the time comes, which I kind of imagine you'd have to do anyway. Maybe it accelerates the process having the opinion, like you start at like phase 3 of the process rather than phase 1. So maybe there's like some cost savings there, but I imagine you have to bring a tax attorney in to ultimately defend that opinion anyway, right? So I don't know. I'm not, we mostly deal with small to mid-sized businesses who really just, I don't think could ever really even practically consider paying $80,000 for an opinion, It's just, it's a little bit out of our area of expertise, but it does not seem necessary based on our experience.
Yeah. So Jamie, let's go. We've got about 15 minutes.
Okay.
This question, we get this one a lot.
No, you cannot.
People hear the beauty of 471C, and it is magical, and we've been using it forever, but a lot of people are just getting privy to it, and so they think when we start talking about amending returns, or other people start talking about amending returns, they think they're talking about going back and amending their returns based on 471C.
No, you cannot do it. There are, of course, very rare circumstances that would maybe be exceptions to this rule, but generally, no, you cannot. A 3115 is a form, it's Form 3115. It's required to change your accounting method. So if you've been in business, especially before 2018, let's say before 2018, when 471C came out and was able to be used, there's no way that unless you filed this 3115 that you can be using the 471C methodology, because it wasn't available to be adopted by you when your business opened and you filed your first return. You cannot, or a 3115 has to be filed with a timely filed tax return. That does not include like a timely filed amendment. So it's an original tax return, timely filed, including extensions. So, you have to do it with an original return filed on time for that tax year. Unless, the only kind of exception is like, if there's some argument that you adopted the 471C methodology the first year of the first filing of your return, and maybe your accountant prepared it wrong or something, like they applied the methodology incorrectly, and then you might have a way to do that. But especially if you filed several years using the same inventory valuation methodology, you definitely cannot go back. You can go back and you can say 280E doesn't apply and give it a shot there to recoup your deductions via the 280E argument, but you have to, going forward with the 471C approach.
Yeah, I think there's a lot of misunderstandings there, even amongst accountants. Mm-hmm. And you probably will get away with it. Like if you
might get away with it.
You probably would. Like you could, but then your position is just kind of weak if the audit, because a lot of people don't even know what a 3115 is. Mm-hmm. Like it's a very complicated tax form that you need to put in there to be able to elect 471Z. And I bet you anything that the attorney or the IRS agents don't even, like, they're not even looking for it. But if they did look for it, you would be screwed.
Yeah, you would be screwed. And it's true. We've had some clients come to us who, their prior accountant switched them to 471C, but there's no 3115, in sight. They don't believe a 3115 was filed. They had never heard of it. That's something that does happen. And like Justin said, it may not, you may never see the consequences of that, but your position is very weak. It's if you do that, the IRS can just simply say you're using the wrong. They don't have to challenge the 471C position at all. They can just say this wasn't available for you to use. You were using you should be using a different methodology. It's
a request for change in accounting method, and they could just say, well, you didn't actually ask.
Yeah, you didn't actually ask.
It's automatic. It's automatic. Mm-hmm. When you do the 3115, you mail it off and you can use it going forward. They don't like send you a letter saying, okay, you're approved. But if they're like, well, we don't like this, we don't like what you're doing here, and I don't see a 3115 on file, then we can just deny it all we can just deny it, and there's no.
Yeah, and maybe to clarify just a little bit, because people might not be super aware of this, but you have to, when you prepare a tax return, your accounting, you adopt like accounting practices on a return, like the very first return you file. And you're supposed to prepare your returns and your accounting consistently year over year. So you can't just switch. You can't be like, 1 year I was reporting an inventory balance, and the next year I just decided I didn't want to track inventory anymore. So I'm not reporting an inventory balance anymore. And the next year, I had an inventory balance, I think I'll put it on. You can't flip flop. You have to do it consistently. Otherwise, the IRS believes you are failing to properly reflect income, which is how they apply their taxes. So
you can, but you may not.
You can, but you should.
So we do have a question from the audience, which is nice, and it's particularly challenging, I think. Because I've never had to be in the position of like, okay, when when they do audit you, like what, and they say no, then what are you going to do? What are we going to do? And that's a good question, I think.
Yeah, I think we would make the exact same argument in appeals. So appeals, like I said, there's kind of layers, right? So an IRS agent is like the first line of defense. And they're going to have a very basic interpretation of the law. They're just going to be following like what they've been told to do. for the most part. And so they're probably, you know, if it gets picked up, if they review it, they're probably going to say, no, 280E is supposed to apply. You go to appeals and you basically request appeals. You know, you're like, can you take, this is our argument. It's the same argument that we presented with the tax return. And you say, we really believe that like this interpretation of the tax law is wrong. Will you review it and see what you think? And then appeals, like I said, could just say no again. And that's when you have to like appeal the appeal and go to, that's when you have to be prepared if you're wanting to continue to defend the position to go to courts. And what's interesting is your argument never changes. It may get more detailed, right, if you're like in court than our little 3-page summary, but the argument is always the same. You're just asking people with more and more authority to hear that argument and make a decision on it. So that's kind of like the court system in the US, right? You have like district courts and then you Court of Appeals, et cetera, all the way up to the Supreme Court. And all the lower courts, they don't have the authority to issue an opinion that contradicts previous Supreme Court precedent. So if there's been a case that's addressed this issue previously, even if the facts and circumstances have evolved, like cannabis is one of those situations, then those courts just do not have the authority to issue an opinion that contradicts that Supreme Court precedent. The only way to get a change is to get that to continue to appeal all the way up to the Supreme Court, and then hope that they have a different opinion, that they're empathetic to the new argument. But what's interesting about this argument that cannabis doesn't fall within the meaning of a Schedule 1 or 2 substance is that specific argument is a novel argument. It hasn't been, as far as I'm concerned, or as far as I know, argued. Go ahead.
I think that it may have been in that. Well, actually, I don't know. That's a good question. I was talking with an attorney group not too long ago, and I can't quite remember. For some reason, they decided they wanted to like try to go for it at the federal court level, which we can do. You now can go outside of the IRS and go into a district court, and that it's novel there. Yeah. I think in the tax courts, we have tried everything, and
I don't know that that's true. I think they may have been speaking to some of the other arguments too. So they're like, because we present like in our disclosure, we present several arguments, and we say we don't think it falls within the meaning. We also say we think it's maybe not, it's not constitutional under the Commerce Clause. We have several arguments, and I think they were saying like, well, if you get into this other court, the tax court has heard the non-constitutionality argument, and they've said no. So, and that's, Canada Provisions is trying to take that argument now to the Supreme Court outside of the tax court structure. But yeah, so just to kind of circle back a little bit, and it plays into what you're saying, Justin, is like each court has their own precedent too. So if a court has heard, there's like layers of precedent. If a court has heard a case and they've issued an opinion, they have to continue to rule in the same manner and issue opinions in the same manner. They have to be consistent. So they're bound by their prior precedent at their level. They're also then bound by like any precedent at a higher level court, like the Supreme Court. So if you have, you might have more success taking a certain type of argument that's never been heard by a lower court, or whatever, to that court rather than a different court. So the court system is very complex, and I'm by no means an expert, but it's interesting. You just essentially, the answer to the question is you continue to make the same argument to the more and more authoritative people until maybe someone has the authority to say something different.
Yeah, and that's probably a little out of our league in terms of, we could definitely represent people in audit, and then, but I would say that that's when the tax attorneys come in and they can take it from here. And there's definitely tax attorneys that feel similar to us. So there's tax courts that may have not heard all these arguments. we're saying that as far as we know, and please, if anybody knows anybody out there where this within the meaning question has been litigated, well, I would be beautiful to know that.
Yeah, we would love to know that.
Yeah. But I do know that for sure it hasn't been heard outside of the tax courts, which is now legal because they overturned the Chevron deference. That's why now you can go outside instead of trying to go through the judicial system within the federal bodies. Like that's what's happening with the DEA right now, right? Where they're like, the DEA, who hates cannabis and is doing everything they can to block it, is now, is the one adjudicating on whether or not it should be rescheduled, and that's why we're getting what we're getting. There's another question, and I would say then we have to probably wrap it up.
Yeah, that's a good question.
Okay, here we go. Well, this is a good question.
That is, I guess. So that's a great question that I'm probably not incredibly
How do precedents ever evolve or change? And I can tell this one.
Yeah, tell it.
Well, yeah, the canon provisions argument is exactly what. So they're saying that 280 or the CSA's application to state cannabis regulation is unconstitutional. They're saying that, hey, this is an intrastate commerce activity. It doesn't affect outside states because we're not allowed to go out of state lines. So back in 2015, Gonzalez versus Reich, the Supreme Court said no.
2005.
2005. Yeah. Oh man, I'm 10 years off. Okay. So so they're saying, oh no, this is a federal issue. So the CSA applies. Okay. Well, now 38 states with medical rec programs, now the canon provision is bringing that same argument back up to the Supreme Court. And yeah, the lower courts are like, oh, there's precedence, so you got to go back up to the top. And if now with this more conservative Supreme Court, so the opinions probably have changed. I mean, they overruled Roe versus Wade, for crying out loud now. So if the Supreme Court rehears this argument that this is an interstate commerce clause, it's a states' rights issue, states should be able to apply their own cannabis regulation, disregarding the CSA, and therefore 280E wouldn't apply. The Supreme Court, based on its character right now, should be hands down, okay, yes, it's a states' rights thing. So that's how it might change.
So yeah, and I just want to clarify a little bit that I think, I may have misspoke earlier in that courts are bound by their prior precedent. I think to an extent, right? So I think it's generally uncommon for precedents to just change. I think there's a higher level that has to be reached if the court has already ruled differently, but it's not impossible to reach that. So that's why and precedent can't be changed at a lower court. It has to be changed at the same level or higher. So the Supreme Court can hear the same type of case it heard previously if the facts and circumstances in the landscape has evolved significantly for some reason. They can hear it again, and they can ultimately rule differently. But it's generally pretty uncommon, although in the last couple of years, we've seen a lot of longstanding precedent overturned at the Supreme Court level.
Yeah. And who you should ask is an attorney.
Yeah,
because we're not attorneys, we're accountants, so we definitely are familiar with laws, especially tax code and whatnot. But that would be, I guess that question would probably be more well directed to an attorney. So final question, because it is now 11 p.m. Pacific or a.m. Pacific time, so that's our time zone. It's been an hour. So the final question that I have is, what are the statute of limitations for amending tax return? What are people doing now? So let me answer real quickly that going forward, 471C, absolutely. Definitely implement that to the fullest that you feel I guess there's some sort of people think, well, hey, if I don't deduct everything, if I pull back and I meet them 50-50, then that's somehow going to be better for you. I don't think that's the case. the thing is you can put in 100% of payroll. You can put in 100% of facility costs. You can put in, our narrative is anything that is required for doing business or for conducting business. We hold back discretionary spending items like advertising and some of those types of things. So that gets your 471C alone will get your tax liability to near legal levels. And then on top of that, we throw in our disclosure canon provisions within the meaning, and we say, hey, 280E doesn't apply. That's our opinion. We also deduct those otherwise disallowed deductions, and we move on. And we've been doing it for 2023, now 2024 tax returns. I shouldn't recommend it, but I think it's up to you.
It's an option. We believe the taxpayer should have the choice to do it. That's, I think, that's my position. That I think there's a good argument.
471C, then you can decide whether or not you want to take the rest of the deductions with some sort of like no 280E approach. Okay, and Jamie, you want to go ahead?
Well, we didn't answer the actual question, which is what are the statute of limitations?
This is my question. This is my question. So.
Oh, this is your question.
I wrote this question.
You have 3 years. Generally, it's 3 years from the date you filed your return, or 2 years from the date you paid the balance, whichever is later. So that's those are the general rules. So right now we're looking at if you timely filed your 2021 return. Not everybody, but most of the businesses that we interact with in the space tend to extend their returns, meaning you probably didn't file your return before April 15th. So if you did extend your return, check that date because your time limit is probably running out. You're probably about done. Like by October 15th, if you're a corporation, you for sure, if you timely filed your return, you'll have passed that statute of limitations. It'll be closed. There are some exceptions depending on like if you have an outstanding tax liability that you didn't pay, if you paid in part. But the general rule is 3 years. So we're looking at the closure of the 2021 statute of limitations this year. That's it.
Okay.
For joining us.
Yeah, I think that's it. So you can find us, of course, if you're on our mailing list and whatnot, and you're getting the reminders to stream in and whatnot. Yeah, you know how to get a hold of us. So
yeah,
hopefully, we'll record this and then we'll blast it out to our mailing list as well, so you can resend it. And I'm going to try to edit it as much as possible because I'm curious if the music at the beginning everybody could hear it, which was crazy. So thanks for tuning in.
All right, thanks everybody.